Real estate investment is one of the primary pillars for United States, US, citizens to build wealth toward retirement. The US property market is highly established and offers various unique tax incentives for its residents. Below is a lesson guide on real estate investing for retirement in America. 1. Why is real estate so popular in the US? Americans favor real estate because of 4 key factors. Cash flow, stable monthly rental income to replace a salary. Appreciation, property values tend to rise over the long term. Protecting wealth from inflation. Leverage, ease of obtaining a mortgage with a low down payment, such as FHA or VA programs for veterans. Tax benefits, significant potential for tax deductions, depreciation, mortgage interest, etc. 2. Common real estate investment strategies. There are several ways US citizens invest, depending on their level of involvement. Strategy description difficulty level. Buy and hold, purchasing single-family homes or apartments for long-term rental. Moderate. House hacking, buying a multi-unit property, e.g., a duplex, living in one unit, and renting out the others to cover the mortgage. Low. Rights. Buying shares of real estate companies on the stock exchange, like buying Apple stock. But for property, no physical management required. Very easy. Short-term rentals. Renting out property via platforms like Airbnb or Vrbo. Higher profit potential but high operational demand. High. 3. Utilizing retirement accounts, STIRA. Most Americans believe that retirement funds, 401k or IRA, can only be invested in stocks. However, there is the self-directed IRA, STIRA, option. How it works. You can move funds from a traditional IRA to an STIRA to purchase physical real estate. Benefits. All rental income and sales profits go back into the account tax-deferred or tax-free if using a Roth STIRA. Strict rules. You cannot live in the property and you cannot perform repairs yourself. You must hire third-party services. 4. Key tax benefits to know. Americans have secret weapons within tax law. 1031 exchange. You can sell an investment property and buy a new one without paying capital gains tax immediately. The tax is deferred until you stop investing. Depreciation. The IRS allows you to deduct the building's value every year as a paper expense. This often makes your rental income look like zero or a loss for tax purposes, even though you are receiving actual cash. Tips for getting started. Improve your credit score. In America, your credit score is everything when it comes to securing low interest rates. Start with a location you understand. It doesn't have to be in the state where you live, out of state. Investing is very common in the US. Prepare reserve funds. Always have an emergency fund for unexpected repairs or tenant vacancies.
Let's create a simple simulation for purchasing an investment property. We will use an example of a single-family home in a mid-growth area, such as Texas, Georgia, or Florida, that is popular among investors. Real estate investment simulation. The rental calculator. 1. Acquisition assumptions. Suppose you buy a house for $300,000. For investment properties, U.S. banks typically require a minimum down payment of 20 to 25%. Property price, $300,000. Down payments, 25%. $75,000. Closing costs. Admin, insurance, legal to 3%. $9,000. Total cash outlay, $84,000. Loan amount mortgage, $225,000. Assume 6.5% interest for 30 years. 2. Monthly cash flow income and expenses. We assume this house is rented out for $2,400 per month. Expense component estimated cost description. Mortgage principal and interest. $1,422, $2.25,000 loan, 6.5%. Property tax, $300, estimated 1.2% per year. Homeowners insurance, $100 annual estimate. Management fee 10%, $240 if using a management service. Maintenance reserve 5%, $120 for future repairs. Total monthly expenses, $2,182. Net cash flow, $2,400. $2,182 sama dengan $218 per month, $2,616 per year. 3. Long-term benefits retirement. Real estate investment in the U.S. is not just about monthly rent. It is about wealth accumulation. Cash and cash return. You earn a net profit of $2,616 from an $84,000 investment, approximately 3.1% per year. This might look small, but wait. Appreciation. If the price rises by 4% annually, in 10 years, your house will be worth $444,073. You gain $144,073 from price appreciation alone. Loan paydown equity. Your tenant is the one paying the bank installments. After 10 years, your debt balance decreases. Your equity actual ownership increases automatically. Tax savings, depreciation. For tax purposes, you can divide the building value, $300,000, over 27.5 years to reduce taxable income. This can save you thousands of dollars in taxes every year. Conclusion for retirement. If you do this with 2 to 3 properties during your productive years, by the time you retire, the bank debt is paid off. You own the properties outright. The $2,400 rental income, which will likely rise with inflation, goes straight into your pocket without mortgage deductions. You hold assets worth millions of dollars that can be sold or passed down as an inheritance. The 1031 exchange strategy based on Internal Revenue Code Section 1031 is one of the most powerful tools used by Americans to build retirement wealth. Simply put, it is a way to sell an investment property and buy a new one without paying capital gains tax at the time of the sale. How does a 1031 exchange work? Imagine you bought a property 10 years ago for $300,000. Today, that property is worth $500,000. If you were to sell it normally, you would have to pay taxes on that. $200,000 gain, which can reach 15 to 20% plus state taxes. With a 1031 exchange, you can reinvest the entire $500,000 into a new, larger property, such as a multi-unit apartment, and defer the tax payments indefinitely. Strict rules of the game. Asterisk, like-kind property. Both the property sold and the one bought must be for business or investment. Purpose is not a primary residence. However, the definition is broad. You can swap a rental house for raw land or an apartment complex. Asterisk, the 45-day rule. You have only 45 days after selling the old property to identify potential new properties in writing. Asterisk, the 180-day rule. You must close the transaction on the new property within 180 days of the sale of the old one. Asterisk, qualified intermediary key. You cannot touch the proceeds from the sale. The money must be held by a neutral third-party key until the new property transaction is complete. If the money enters your personal bank account, the tax break is voided. The swap till you drop strategy. Many real estate investors in America use a strategy informally known as swap till you drop. Asterisk step 1. Buy a small property single-family home. Asterisk step 2. Once the price rises, perform a 1031 exchange into a small apartment building fourplex. Asterisk step 3. Repeat the exchange into an even larger apartment complex. Asterisk step 4. Continue this throughout your life to avoid taxes. Asterisk step 5. Inheritance. When you pass away and leave the property to your heirs, they receive what is called a step-up in basis. Important with a step-up in basis. The property's value for tax purposes is adjusted to the market value at the time of your death. All the capital gains taxes you deferred for decades are completely wiped out. Your heirs can sell the property without paying taxes on the appreciation that occurred during your lifetime. Comparison example. Scenario without 1031 exchange with 1031 exchange. Sale process $500,000. $500,000. Capital gains tax est, $40,000 paid now. $0 deferred. Funds for reinvestment, $460,000, $500,000. Buying power with mortgage still at $1,8 million. With a 1031 exchange, your purchasing power for the next property is significantly higher because your capital isn't cut by the government along the way. Real estate investing is indeed very profitable, but without proper preparation, it can become a burden during retirement. In the United States, there are specific risks that investors must anticipate. Here are the primary risks and how to mitigate them. 1. Liquidity risk cash crunch. Real estate is an illiquid asset. You cannot sell a bathroom or a door when you need quick cash. The process of selling a home in the U.S. typically takes 30 to 90 days. Asterisk risk. If all your money is tied up in property and an emergency occurs, you might be forced to sell below market value. Asterisk mitigation. Always maintain a cash reserve of at least 6 months of operating expenses per unit. 2. Vacancy risk. Mortgage payments must be made every month, regardless of whether you have a tenant or not. Asterisk risk. If the property remains vacant for 3 months, you must cover the mortgage out of your own pocket. Asterisk mitigation. Choose locations with strong job growth and good schools, high ratings on Zillow to ensure rental demand remains high. 3. Tenant issues and eviction. In some U.S. states, the law heavily favors tenants, tenant-friendly states such as California or New York. Asterisk risk. The process of evicting a non-tenant can take months and cost thousands of dollars in legal fees. Asterisk mitigation. Asterisk perform rigorous background checks, credit score, criminal history, and eviction records. Asterisk consider investing in landlord-friendly states such as Texas, Florida, or Georgia, where legal processes are generally faster. 4. Unexpected capital expenditure. Major repair costs can wipe out your annual profits. Asterisk risk. A leaking roof or a broken HVAC system heating, cooling, can cost anywhere from $5,000 to $15,000 at once. Asterisk mitigation. Conduct a professional inspection before buying and set aside 5 to 10% of monthly rental incomes, specifically for a CapEx fund. 5. Interest rate and tax hikes. Asterisk risk. Property taxes in the U.S. are determined by local governments and can increase at any time. If you use an adjustable rate mortgage arm, your monthly payments could skyrocket. Asterisk mitigation. Always use a mortgage 30-year fixed so your payments never change, even if inflation or interest rates rise. Summary for a safe strategy for Americans. The key to a peaceful retirement through real estate is to avoid being too aggressive with debt. Over-leveraging. Ensure your cash flow remains positive, even if rental prices were to drop by 10%. Important note, always consult with a certified public accountant because property tax rules can vary significantly from state to state. Below is a step-by-step checklist to begin your real estate investment journey in the United States. This process is designed to ensure you have a solid foundation before spending a single cent. Phase 1. Personal finance preparation. Before looking at houses, make sure your financial house is in order. Asterisk, check your credit score. FICO score. In the U.S., a score above 740 will grant you the best mortgage interest rates. Asterisk, build a cash reserve. Ensure you have a personal emergency fund separate from your property down payment. Asterisk, get a mortgage. Pre-approval. Contact a lender or bank to determine how large of a loan you qualify for. This ensures sellers take your offer seriously. Phase 2. Determining strategy and location. Asterisk, choose a strategy. Do you want a house hack, live in one unit, rent out the others, or go for a pure buy and hold? Asterisk market analysis. Use sites like Zillow, Redfin, or Realtor.com. Look for areas with asterisk positive population growth, asterisk low unemployment rates, Asterisk high-rated schools, which typically attract equally family tenants, asterisk calculate the 1% rule as a rough benchmark. Look for properties where the monthly rent is close to or at least 0.8% to 1% of the purchase price. Phase 3. Building your team, the core 4. Real estate investing is a team sport. You need these key people. Asterisk real estate agent. Find an agent who specifically works with investors, not just residential home buyers. Asterisk property manager. Essential if you don't want to collect rent or fix toilets yourself. Asterisk lender, mortgage broker, to handle your financing needs. Asterisk contractor handyman, to perform repairs or light renovations. Phase 4. Property analysis and making an offer. Asterisk run the numbers. Input all costs into an investment calculator. Mortgage, taxes, insurance, management fees, and repairs. Ensure there is positive cash flow. Asterisk making an offer. Do not fall in love with the property emotionally. This is a numbers business. Asterisk due diligence. Once an offer is accepted, hire a professional home inspection. Check the structure, roof, plumbing, and electrical systems. Phase 5. Closing and management. Asterisk closing. Sign the documents at a title company or attorney's office. Asterisk property insurance. Ensure you have a specific landlord policy, not a standard homeowner's insurance policy. Asterisk find a tenant. Conduct rigorous screening check, pay stubs, and credit history. Pro tip: leverage technology. Use apps like Stessa or Roofs to monitor your investment performance digitally and automatically. This is extremely helpful for year-end tax reporting. Choosing the right property manager (PM) is crucial, as they are the ones who will maintain your asset and communicate directly with tenants. In America, poor management can lead to high vacancy rates or legal issues. Below is a list of key questions you should ask, along with an explanation of why each question matters. Key questions when interviewing a property manager. 1. Fee structure. Asterisk question: what is your monthly management fee percentage? And are there additional costs, such as leasing fees or renewal fees? Asterisk explanation. Average fees in the US range from 8% to 12% of the gross monthly rent. Ensure you know if they still charge fees when the property is vacant. Avoid PIM as who do this. 2. Tenant screening process. Asterisk question: what are your screening standards for prospective tenants? Asterisk explanation. A good PM must check credit scores, criminal history, eviction records, and proof of income, usually at least 3x the monthly rent. Rigorous screening is your best protection. 3. Handling maintenance. Question: what is the spending limit for repairs that requires my prior approval? Asterisk explanation. Usually, a threshold is set, for example, $300. If the cost is below that, the PM fixes it immediately. If above, they must contact you. This ensures you aren't blindsided by large bills. 4. Experience and portfolio. Question: how many units do you currently manage and how many staff members do you have? Asterisk explanation. You want a PM large enough to have organized systems, but not so large that your property gets neglected. Also, find out if they manage properties similar to yours. 5. Vacancy rate. Asterisk question: what is the average time it takes to find a new tenant? Asterisk explanation. If it takes them more than 30 days on average in a busy market, that's a red flag. It means their marketing is ineffective or the price is set too high. 6. Eviction procedure. Asterisk question: what is your process if a tenant stops paying rent? Asterisk explanation. The PM must understand local laws. Ask if they handle the court process or if you need to hire your own attorney. Some PMS offer an eviction protection plan, eviction insurance. Additional tip: check the management agreement. Before signing, ensure there is a termination clause. You should be able to terminate the contract, usually with a 30-day notice if they are not performing well. Legally, United States, citizens are not required to use a manager or an agent to sell their homes. However, there is an important distinction in roles to understand between a property manager and a real estate agent. Below is an explanation of the options Americans have when selling a home. 1. Difference in roles. Agent versus manager. Asterisk property manager, typically responsible only for managing tenants and property maintenance while the home is being rented out. They rarely handle the actual sales process. Asterisk real estate agent realtor. This is the professional typically hired by Americans to sell a home. They assist with marketing, negotiations, and handling legal documents contracts. 2. Options for selling in the U.S. A. Using a real estate agent, most common, approximately 85 to 90% of U.S. residents use an agent's services. Asterisk pros. Agents list the home on the MLS Multiple Listing Service, a central database that ensures the home is seen by thousands of buyers and other agents. They also handle complex negotiations. Asterisk costs. The homeowner pays a commission, usually 5% to 6% of the sale price split between the listing agent and the buyer's agent. BFSBO, for sale by owner, selling the home yourself without an agent. Asterisk pros saves the 6% agent commission fee. Asterisk risks. It is difficult to market the home broadly. The seller must understand the very strict property laws in the U.S. If a seller incorrectly fills out disclosure documents, statements regarding the home's condition, they can be sued in court later on. C. Selling to IBRs or investors. Companies like Opendoor or OfferPad buy homes quickly for cash. Asterisk pros. Extremely fast, can close within 7 days and requires no renovations or open houses. Asterisk cons. The purchase price is usually lower than market value because the company accounts for their convenience and risk. Conclusion. Americans are not obligated to use a manager or an agent, but the majority still choose to use a real estate agent because the legal and administrative systems for property sales in the U.S. are highly complex. Without an agent, the risk of making a legal error is very high. Investing in real estate in the United States requires precision in calculating numbers due to its detailed tax system. There are 3 primary indicators that investors typically use to measure profit. 1. Cash flow. Monthly cash flow. This is the net profit that goes into your pocket every month. After all expenses are paid. Formula. Rental income mortgage plus property. Tax plus insurance plus management. Fees plus maintenance, capex reserves. Greater than, example rent, $2,4, total expenses $2,182, $218 month, $2,616. Year 2. Cash on cash return. This measures how quickly the actual cash you invested, down payment and closing costs, returns to you in the form of annual profit. Formula. Annual cash flow divided by total cash invested, x 100%, greater than asterisk. Example. If you spent a total of $100,000 for the down payment and admin fees, and your net profit is $2,616, your asterisk $2,616 divided by $100,000 x 100 sama dengan 2,6% COC. 3. Cap rate, capitalization rate, used to compare one property to another without accounting for debt, as if you bought it in cash. This shows the potential profitability of the asset itself. Formula. Annual net operating income NOI divided by property purchase price. Important, NOI does not include mortgage payments. Example, if the net income without a mortgage is $18,000 a year and the house price is $300,000, $18,000 divided by $300,000 x 100% cap rate. Profit metric comparison table. Metric. What is measured? Why is it important? Cash flow surplus net cash ensures you aren't losing money every month. COC, Return on invested cash compares real estate versus stocks fixed deposits. Cap rate pure property value determines if the house price is too high. Appreciation, increase in asset value. Long-term profit when the house is eventually sold. Hidden profit factors in America. In addition to the three figures above, investors in the U.S. receive extra benefits. Equity buildup. Your tenant is essentially the one paying off your bank debt. Every month, your debt decreases and your ownership equity increases. Tax benefits. Depreciation. The U.S. government allows you to depreciate the value of the building as a tax-deductible expense. This means even if you have a cash profit, you might show a loss on your tax return, avoiding taxes on rental income. Let's run a calculation simulation. For a standard investment property in the United States, we will use a single-family home scenario which is commonly found in markets like Texas or the Midwest. Property scenario. Purchase price $300,000, down payment 25%, $75,000 standard. For investors in the U.S. Asterisk, estimated monthly rent $2,500. 1. Estimated monthly expenses. In U.S. real estate investing, we must set aside various costs before calculating net profit. Expense component monthly estimate explanation. Mortgage principal and interest. $1,45, assuming 6,5%. Interest 30, year fix. Property tax $300, estimated at 1.2% of the home value per year. Homeowners insurance $100, specialized landlord policy. Property management 10% $250. Fee for professional management services. Maintenance reserve 5% $125, emergency fund for AC service, plumbing, etc. Total expenses $2,225. 2. Profit indicator calculations. A monthly cash flow. Rental income $2,500. Total expenses $2,225. Taxed BEF per month. You receive a net profit of $3,300 per year. P cash on cash, return ko C, assuming the total initial cash capital is $85,000. $75,000 DP, tambah $10,000. Closing costs, admin fees, annual, profit, capital, times, tax BEF. This is your direct cash yield in the first year. C. Cap rate. NOE nets, operating income without mortgage payments, is approximately $20,700 per year. No. A. Purchase price times tax BEF. This figure indicates the property is quite healthy as it is above the average interest rate for fixed deposits. 3. Additional gains. The hidden gains. The figures above do not include two major factors. Appreciation. If the house price rises by 4% a year, you gain an additional $12,000 in asset value. Equity buildup. Out of that $1,450 mortgage payment, roughly $300, $400 goes toward the principal debt. This means your tenant is essentially saving money for you every month. Conclusion. Although the cash flow looks modest, $275, your total wealth assets plus debt paydown plus cash is actually growing much faster. Here is the interest rate analysis and break-even point calculation for your property investment. This scenario uses a house valued at $300,000 with a 25% down payment $75,000 as the base. Kasatu interest rate impact analysis. The interest rate heavily determines how much pocket money remains. After all, obligations are met. Let's look at the comparison. Interest rate monthly mortgage P&I, total operating expenses, asterisk EST, cash flow, rent, $2,5. 5,0% optimistic, $1,208, $1,983, $517 man, 6,5%, current, $1,422, $2,197, $303 man, 7,5% high, $1,573, $2,348, $152 months. Asterisk includes taxes, insurance, management, and maintenance reserves. Conclusion. every 1%. Increase in interest rates can cut your cash flow by approximately $150 to $100 per month. This is why U.S. investors closely monitor the central banks, the Fed, interest rate policies, kedua break-even calculation, minimum rent. This is a critical figure. What is the lowest rent you can accept before you have to pay out of your own pocket? Using the current interest rate scenario, 6.5%. Total fixed expenses, $2,197 per month. Break-even point, $2,197. If you receive rent below $2,197, the investment is considered to have negative cash flow, a cash loss, each month. Wise investors typically look for properties that have a margin of at least 10 sampai 15 above this break-even point to ensure financial security. Why is this number important to you? Negotiation strategy. If the market rent in that area is only $2,100, while your break-even is $2,197, you must negotiate a lower purchase price for the house so that the mortgage payment decreases. Recession security. Knowing your break-even number helps you understand how much you can lower the rent during tough economic times without facing bankruptcy. Investment property analysis summary. Property value $300,000 down. Payment $75,025. Target rent $2,500. Sensitivity analysis. Interest rate impact. This table demonstrates how fluctuating mortgage rates affect the monthly net profit, cash flow, mortgage rate, monthly P&I, total operating expenses, asterisk. Net monthly cash flow, annual cash flow, 5,0% optimistic, $1,208, $1,983, $517, $6,204, 6,5%, baseline, $1,422, $2,197, $303, $3,636, 7,5%, risk scenario, $1,573, $2,348, $152, $1,824. Operating expenses include property tax, 1.2%, homeowners insurance, property management, 10%, and maintenance reserves, 5%. Dua break-even analysis. To maintain a neutral cash flow, neither profit nor a loss, the property must achieve the following minimum rental income: break-even rent at 6.5% rate, $2,197 month. Safety margin, 15%, $2,526 month. Note any rental income collected below. $2,197 will result in a negative cash flow, requiring personal out-of-pocket funding to cover monthly liabilities. 3. Strategic insights. Leverage efficiency. At the baseline 6.5% rate, the property remains profitable. However, a rate increase to 7.5% significantly compresses margins. Negotiation target: if the current market rent is below $2,200, we should consider a lower purchase price or a higher down payment to reduce the monthly debt service. Total return. In addition to the cash flow above, the investment will benefit from equity buildup, approx. $3,6, $4,2 in year 1, and potential market appreciation. Real Estate Investment Executive Summary. This format is designed to provide a comprehensive overview for investors or business partners. Real Estate Investment Executive Summary. Target assets: single-family residential, purchase price $300,000. Capital requirements. Description: amount: down payment 25%, $75,000. Estimated closing costs $10,000. Total initial cash investment $85,000. 2. Annual income and performance metrics. Based on a 6.5% interest rate and $2,500 monthly rent. Metric annual value performance indicator. Gross rental income $30,000. Total revenue before expenses. Net operating income $20,700 profit before mortgage payments. Net annual cash flow $3,636, 3.8% cash-on-cash return, 5-year projected IRR 14.5% comprehensive annual return. 3. Operational and break-even analysis. Component monthly estimate notes. Mortgage fee dan E, $1,422 fixed 30, year term 6,5%. Operating expenses $775, taxes, INS, MGMT, and maintenance. Total monthly outflow $2,197. Break-even rent requirement, target rent $2,500, provides a 12% safety margin. 4. 5-year wealth projections. Profit source, 5-year total description. Cumulative cash flow, $20,396, total liquid profit collected. Equity buildup $21,000, mortgage principal paid by tenant. Market appreciation $65,000. Estimated asset growth 4% C. Total projected gain $106,396. Estimated wealth increase. V. Investment conclusion. The property demonstrates a strong IRR of 14.5%, significantly outperforming traditional savings and bond yields, while the monthly cash flow is conservative. The wealth accumulation through equity buildup and market appreciation provides a robust long-term financial position. The current target rent offers a healthy buffer above the break-even point.